receivable of lease, receivable of interest, rent, maybe rent from residential and rental properties, and other income. And payable would be same. Once you receive lease, that needs to be paid to the investor. Again, same interest payment needs to be distributed. Rent distribution is required. Other income, that also it needs to be distribute.
When it comes to
Structure of a private equity fund, you're saying?
when you're saying
Hmm.
what this is right? Management fees.
No, management fees and all that is something different. See, private equity gains, it means in a real estate private equity, management fees that would be there so that you can charge it 2% directly on the capital commitment. Let's say commitment is 2 crore. So you can directly charge 2% on 2 CR, right? And update it in the books of account, because that is initially when the investor paid fully 2 crore. At the same time, accountant calculate management fees as per the agreement and ask investor to pay it. So investor means at the time of initial capital call, so investor paid your management fees also. So let's say 2 crore fees every time. So in a 4 call, I decided to execute in 4 calls. 25, 25, 25, 25 lakhs in one call. Sorry, 50 lakhs, 50 lakhs, 50 lakhs. Let's say 4 call, that will be, means 2 crore that will be called in 4 calls, capital calls. So every time management fees will be charged on 50 lakhs. Then 50 lakhs into 2% divided by 100. So in a private equity, see, there are two ways to calculate the management fees. One is on the basis of AUM, so which is called asset under management. And you would have worked on the same in hedge fund, if I'm not wrong.
Yes.
And in a private equity, fees we calculate on the basis of commitment. Whatever commitment that fund received, on the basis of that, management fees will be calculated.
Even if this unused also
So you cannot charge management fees on invested capital. That's the secret. So how it works, I'll explain that. Let's say 2 crore is the main capital, which is a committed one. And till time, let's say the 4 capital calls, $50 lakhs, 50 lakhs, 50 lakhs. Capital call, capital call. Let's say this capital call executed in January. This is in March. This will be executed in June and September. So at the time of capital call, 2% fees that you can ask. So once you ask, then you cannot ask for management fees again when, let's say, you have charged fees, 2% management fees on with this particular capital call. So what it means, only you can charge the that management fees on pending or remaining capital calls. But in short, if you see, this is an unused portion, right?
Yes.
So fees will be charged on unused portion, management fees. But at the time of capital call only, that fund will able to charge. Otherwise, you cannot charge it because it's a one-time fees, right? It's a one-time fees where fund will charge it. So directly you need to charge 2%, 3%, whatsoever it is, directly on the capital, where investor will pay that to you. And while drafting the capital call, you need to do the same. So it means you need to brief about it, total commitment to CR. There are 4 calls, first, second, third, fourth. So now this is a time of third call. So where in the month of June, let's say 1st of June is the due date. Then you need to provide bank account, let's say JP Morgan, Goldman Sachs. So you need to provide all that information where investor will make the payment. And also you need to brief about capital the management fees as well. So management fees is around 2% on 50 lakhs. So you need to pay the 2% separately to the same account, because 50 lakhs is the net capital call amount. So that will be invested, and 2% that is required as a cost of investment. So in that way, you need to execute the capital calls also. Right. Here, again, to the capital call, they call it as a drawdown as well. So capital call, you can call it as a drawdown in other way around. Drawdown. Committed capital, you can call it as a total commitment. Total commitment. And in a hedge fund, to the drawdown or capital call, you call it as a subscription. Here you would see 2 things. One, all payable expenses, you call it as a distribution expenses, and all the other expenses should be your callable expense, call expenses, but not in this way. So let me just brief about it. Call and distributions expenses means at the time of call of capital, we ask investors to pay management fees. Let me just show you something quickly. Means I have that in draft. So what makes sense to note it down like this. So this is your list of expenses. Call means organization cost, legal, due diligence, custody, bank, audit, tax, accounting, other. So at the time of distribution, the other expenses come into picture. See this. Capital call, stock, partnership expenses, management fees. Means at the time of return of capital. So loss of investment. So if you see any loss as such, so you need to charge those expenses also. So it means here you would see categorization of expenses. One is call expenses. So means at the time of call, you need to ensure that you are charging all those expenses to the investors. And at the time of distribution, it means, or at the time of redemption, you need to calculate all the expenses and apply to it and pay the remaining amount to the investor. Okay. So this is how means your job would be in the private equity business. One at the time of call expenses and at the time of distribution. Means related to redemption. Return of capital expenses. And related to management, or I would say administration expenses. Why? Because it's a partnership business, right? It's a partnership business, so both partners needs to contribute to the expenses as well as means at the time of distribution also all the expenses it needs to be calculated and applied and even allocated to the partner's capital book. This is how fund accountants works in private equity. Your main job would be to record the daily expenses, post the accounting entries in the books of fund, preparation of trial and verify it and calculate total assets, total liabilities, and total expenses, and then execute the allocation part. Allocate it to the total means assets, liabilities, unrealized gain and loss, everything to the investor's account. That's it. And apart from that, you would see regulatory other reports also, regulatory compliance audit, but you would see different teams. So it's not a job of accountant to perform everything. So where there are different teams, so they take care of it.
Yes.
If they require any input, you need to support or share that input with them. That's it. Okay. Again, tell me other questions if you have any. Otherwise, we'll start with the mock interview.
Uh, what's due diligence?
Due diligence, it means same the accounting, reporting, auditing, everything that should means executed in a proper way. That's it. Due diligence, it means let's say if the security is received to you, but that is not yet set up in the internal books of account, right? Because every security, once the fund manager buy it, it should be set up. But you forgot to set up it. The TAT was, let's say, buy plus 1 day, means T plus 1 day. That was the TAT. So you forgot it, and after 1 week, you got to know, okay, so new security was bought, but you couldn't set up it in the internal system. Where so you have missed it, means it was a miss from your side. Think from that aspect. So did you follow the due diligence? No. Due diligence, it means it's a checklist. And I'm sure in the fund accounting also you would have followed the checklist to follow the A, B, C, D, E, F, G checks, apply to it, and make sure you have completed each and every task on time. So in a fund accounting, deadline is the key aspect where each and every accountant needs to work as per the deadline. It can be to record the trades in the books of account, calculation of fees, apply the expenses, allocate the expenses and income, measure the total assets and all, even to help regulatory teams to filing regulatory files on time, right? So that comes under your due diligence. Means whatever task that you have allocated, it needs to be performed on time. So that means it's a due diligence.
So, I have last three more questions. What is the form reset? So, the reset is like what the again brings over will be if we have to continue, then it will be again access this form, or let me terminate the agreement like it will be the contract,
Okay,
or yeah.
I'll explain it, don't worry. Swap reset. Re and set. Both are different things. Re it means with the new condition, right? Reset with new. Reset with new conditions. Swap reset with new conditions. How this will work, we'll discuss here. We'll take the 1 year example. Okay. Quarter 1, Quarter 2, Quarter 3, and Quarter 4. Let's assume it. The underlying assets was equity swaps, equity portfolio, right? Equity portfolio. So equity portfolio, let's say, so there was a counterparty who is holding equity of 1 lakh, where securities were include TCS, Wipro, HDFC, right? So where the pattern was, let's say, 50,000 in TCS, 30,000 in Wipro, and 20,000 in HDFC. So in short, all three securities represent to the equity portfolio A, right? And there is a one guy which is B, who is looking for a portfolio. See, who don't want to hold any securities as such, but who is looking for an exposure of 1 lakh rupees portfolio. So B is interested and B is ready to pay. B is ready to pay 5% per annum on portfolio amount. So this is the agreement details, key details. B is okay with 5%. If the A is okay with 5%, then agreement will be executed between A and B, and this is become your equity swaps. So this has become your equity swaps. One counterparty will exchange the entire portfolio with B. When we say entire portfolio, it means I'm talking about profit and loss. Both will be exchanged. See, anyways, B want 1 lakh valuation. Sorry, A want valuation of 1 lakh. Whether it is profit that portfolio generates profits more than 1 lakh or less than if portfolio goes below the 1 lakh, that's absolutely fine. So A will have the same investment, which is 1 lakh under any circumstances. Why? Because it's a equity revenue swaps. Equity revenue swap. Revenue, it means it contains of profit and loss both, correct?
Yes.
And B is entitled to pay 5% fixed on 1 lakh to A. And A is entitled to pay whatever happened with the equity portfolio. If the price goes up or down, so that will transfer to B. Simple. Whatever happened, that it would be responsibility of B. It's not the responsibility of A then after the execution of equity swaps contract or equity revenue swaps, whatsoever it is. So now let's assume it's a equity swaps contract and where the A and B both are agreed, and then terms will execute here on paper, and then it looks like this. So every quarter, and they have also set the reset period. Every quarter contract will reset. So here first quarter end, what happened? Let's say portfolio price changed, and which is reached to at 1 lakh 50, right? Total portfolio value which is reached to at 1 lakh 50. How? So there is a capital gain with TCS of 50,000. Just an assumption, okay?
Yeah.
So total profit and loss of A portfolio would be at 1,50,000, right? Then think from a B perspective, B will entitle to pay divided by 4, that becomes 1,250, because it's a quarterly, right? In 1 year there would be 4 quarters. So 1,250. So now see the difference, 1,50,000 and 125. If you see, B will transfer this amount to A, and A will transfer 50,000, because 1 lakh is the equity valuation, right? So where 1,50,000 minus 1 lakh, so net 50,000, where B will transfer to A. 1,250, 50,000. See, this is the difference. Now we will realize why receipt is important. See the difference. B made a huge profit without holding any physical assets, and A make only 1,250 profit. Just because he don't wanted risk, he was looking for how he can mitigate the risk, and he mitigated risk with the 5% interest payment on portfolio. And here in the first quarter, if you see the cash flow, A is in a loss. Loss of how much?
48,
48,750.
yeah,
And how much profit the B earned?
same one.
In a fund accounting, we call it as a revenue, and we booked it even adjustment entry, a revenue from swap contract, interest revenue. So here, so A will call expense and B will call revenue eventually, and they'll book the adjustment. And as an accountant, you need to do the same, right? But after the completion of 1 quarter, you realize that so A incurred huge loss and B made a huge profit. Then, if you see the value of investment, equity portfolio value, underlying value change, right? From 1 lakh to 150, correct?
Yes.
If the underlying value changed, means for this particular quarter, the second quarter, if the underlying value changed from 1 lakh to 1,50,000, so don't you think that the 7% or whatever 5% interest which was decided, if you see this one, this was decided, so it needs to be charged on new underlying amount,
Yes.
right? This is the one aspect. And now he got to know that, he realized it. So B made a huge profit. Then A will not agree with the 5% interest payment then.
Yes.
They will ask for a 10% minimum, because he realized the potential of his or her portfolio. So it means for a next quarter, the terms now changed. Terms changed, which is 10% on 1,50,000. So this is how reset come into picture. And every quarter you would see ups and downs with the investment. And then automatically this particular contracts will reset on time to time. So I'll take the same example with the loss. Let's say it was decided 1,50,000, and now unfortunately the TCS couldn't perform well, and the other two stocks, or let's say other two stocks perform very low, and the investment value which is reached at 20 and here 10. So it means there is a loss of 20,000 and current valuation of P&L or portfolio value is 1,30,000. 1,30,000. So now portfolio value means the after the reset, the value was 1,50,000, right? So you calculate interest payment on 1,50,000 and see 10,000. 1,50,000, 10% divided by 100, that becomes 50,000. 50 divided by 4 becomes 7 point, no, 3,500. 3,500, no, 3,750 something. 3,750. So now you think 3,750 plus the loss of 20,000, who will bear it? So it means there is a loss in portfolio, right? So underlying assets value was 1,50,000, but at the current value, the price which is at 130. So who will bear that? So now if we then so here it becomes complex for B now. So here if you see the loss of 20,000 plus 3,750, total 2,3,750 would be the loss on investment for a B, and same percentage where 20 plus 3,750, which is goes around 750, so which will receive to A. Why? It's a revenue swaps that contains profit and loss on underlying assets. If the loss incurred, then interest paying counterparty would be in huge loss. Loss, it means huge loss. Revenue swaps and yeah, both are same. Total return, it means we are talking about portfolio. This whatever returns that incurred, so we are talking about total returns. And why the reset is important now, if you can relate here, now at the end of the quarter second, just calculate the benefits of A. A would be in profit 2,3,750 and B 2,3 minus 2,3,750. So B is in loss now, and for a third quarter, underlying assets should be 1,30,000, where so B can deny to pay 10%. So you might see different interest rate, let's say 7.5%. So this is how your terms changes on time to time.
To know our questions are this like so let's say this both of them either one of the person is united like this like pay whatever it is happening. Let's say it's a defaulted by someone. Then what is called is a swap point there for.
Say it's a very complex, I would say, but again I'll tell you. Now you think you don't know the counterparty, but still you want to enter in the contract. You don't know my face, you don't know my name, but still you want service from me. What will you do? Think practically. You don't know my name, you don't know my service, but still you are interested in my product. What will you do?
So I'll be like have a trust on that.
So don't think emotionally, think practically from a business front. Trust and all this is a bullshit. No one trusts to each other. In a market, no one trusts to each other.
Service model via one channel or via contact, so that will be when the proof of copy as a registry for your service. So if you have defaulted it, then I don't know, like back to
So don't you think that you will opt for an insurance facility before entering into the contract? So someone will ensure you that if the counterparty defaults on his or her payment, so that the insurance company or insurer will pay the all benefits to you. Don't you think that? And here CDS will come into picture. So it means it's a very complex. And same thing, what do you think? So if you see, so why the A will pay 48750, and how this guy will make money? See, A is not stupid, okay? A know it, A's portfolio potential. And even though A will do the valuation of his portfolio, then if the price of portfolio goes up, then immediately after the entering into the swaps, A will buy the call option as well. A will bear the premium, that's fine. Let's say just 1000 or 2000. So he'll pay 1000 and 2000 and he'll buy the rights. If the price goes up, so automatically he'll make the money through the call option, right? Let's say through call option, won't be exactly match, but you would see similar, return. So A can mitigate the risk eventually. Let's say portfolio value was this, and now reach to the 150, right? So it means he immediately will enter in call option to protect his portfolio. So here call option, let's say enter at same price, and call option generated the return of 30,000. But due to the swaps, the same A counterpart is in a loss of 50,000. Correct?
Yes.
So now this is what hazing, guys. It's very simple. This is what's hazing. So now see the difference. 50. So he has a profit of 30 from call option, and he has a loss. He or she has a loss of 50,000 with the portfolio A. So he means that particular investor tried a lot to mitigate the risk. See the first example, you see the loss means total 48750, and if let's assume it that the same counterpart entered into call option immediately to protect the portfolio, then you would see 30,000 profit generated from the call option and 50,000 loss incurred in the that through the swaps agreement. So if you see he mitigated around 30,000 from the call option. So it means net, now just calculate the net liability of A, that would be around 48,750 minus 30,000. So that becomes 18,000 around. Say this. This is what. So here effectively they know it how to hedge their assets and all against the market uncertainties. So we think in that way, but they think in a very smart way. They know it why they have entered it, and on top of that, let's assume it at the end of the quarter here, instead 23750, let's assume it's a 500 crore value. So A make the 500 crore and B lost 500 crore, and but at the time of payment B declared is bankrupt, or declared it as the B is not able to pay the 500 crore. Then, so don't you think that that is a huge risk? So now
Yes.
you earned money, but at the time of payment, B is denying to pay it. Then what makes sense? Then why you have entered it in swaps? And that's what CDS come into picture, where so B always, or A or B, both will try to protect from the bankruptcy events through protection. And then protection would be CDS. So it means on the value of this contract, swap contract, whatever the value is, so where both the counterparts will pay the protection money. And by CDS. At the time of reset, if you see the counterparty is not following the obligations, or if the counterparty declared bankrupt or any default event as such, where CDS insurer, so it means insurance companies, they'll take care of the payment and other consideration. See in the if you see, means you would see multiple strategies. Okay, it's not something only reset. With the resets you would see CDS, with the resets you would see call option, put option, maybe future. So you would see different other derivatives also come into picture. Yes, good. Yes. So depends on, so it means why I lost that, so you think, practically think about it. So in the second scenario also, that this counterpart lost it. So don't you think that, so B will sit, relax, and wait for a loss? Try to immediately hedge the risk, right? Hedge, it means try to buy options and then see how he'll pay the premium and buy the options, put options. Where put option will help B to get the recovery of at least some amount of losses. Otherwise, to sit, relax, and wait it. See, that retail investor, they do it. But the smart investors, they follow the very different strategies. They know it how to play with this product.
Yes.
Now,
When the upfront fee will come,
in the swap contract you're talking about,
is
but with the, see, upfront fees, even if that comes in swap contract, that's what I'm asking.
yeah.
With,
Yes.
is it related with the swaps, or maybe
Yeah.
even though you would see upfront fee in a loan contracts as well, loan amount. So if you want credit card, if you want debit, if you want even debit card, or if you want any credit line as such, line of credit or maybe loans, so counter that bank issuer, they charge upfront fee 2%, 3%, 1% directly on the loan amount.
I was asking about swap.
In the swaps, that works in a different way. Front fees, it means one that you can say the counterparty, because see, both the counterparts, they appoint one agent, right, to maintain all this. So it means they appoint a broker. So broker take care of it, all the reset part and everything, to update the statement, to process it, the benefits, to ensure that the both the counterparties, they have processed the payments on time. So I'll tell you how this executed. Both the counterparties, they deposit the amount to the escrow accounts. What do you think? Why they'll take the risk? No, see, in this finance market, no one no one will take the risk. As simple as that. It's a bloody business. So what they'll do, they'll deposit the amount to the escrow account. Both the counterparts will deposit the amount to the escrow account. Let's say A and B, both. A deposited, let's say 1 lakh. B deposited initial 1 lakh. That will be in the escrow account, and that escrow account will be monitored by the broker, prime broker. Prime broker, where prime broker will charge,
Commission for both.
yes,
Brokerage.
Yes. And that becomes your upfront fee, where broker will charge upfront fee both the counterparts 1%, 2%, let's say 1% on this amount. That becomes the upfront fee. Upfront fee. But sometimes the difference of this amount, difference of this amount also you can call it as upfront fee of the contract. So that depends on the purpose of that particular transaction. But this difference means usually we call it as a coupon. Coupon 1, coupon 2. And sometimes same coupon that treat as incoming wire also in the fund accounting. Incoming wire or unadvised cash, or maybe upfront fee. Official word is coupon or interest payment.
Even we can see cash flows.
Yep, even you can say cash flow also. And here the important is, until these deals get executed or mature, broker maintain the escrow account and ensure it the minimum payments, everything. It's kind of margin, but it's not like margin. But yes, you can say it. So both the counterparties will deposit and then they'll enter into swaps agreement. Why? Just to reduce the risk. Take the first example where one counterparty transfer 48750, right? Means A transfer 48750. So here broker will minus 48750. See, once the loss incurred, no one will pay it. So that will get delay. No one will, if the loss is widened, then so you would see that will lead to the huge losses as well. And that's what broker asks for a means both the counterparts they'll deposit amount in escrow account. And here net amount balance that will be reflected. And here for it, that will be added. When in the second quarter, so now A is in profit, which is 23750. And it will minus from here. So this is how your cash flows. Cash flow in, inflow. Outflow, inflow, outflow. And that statement we call it as a cash flow statement. Broker maintain it. And we check the same details. Swap 1, swap 2, let's say F leg. And V leg. V means variable, F means fixed. A will receive fixed. Why? Because B will pay interest payment and B will receive variable leg because A will pay all the variable in the portfolio of A. Whatever will happen, that will transfer to B. And the difference of F and V leg, that will treat as a coupon. And broker will charge upfront fee because broker will manage all this entire things.
Thank you for before going to the last question, small clarification on management fee calculation. Management fee is calculated based on the common AUM or gross AUM?
Depends on the, see, there are types of funds, right? Open-ended, close-ended, side pocket. So depends on the fund structure. Your AUM will be calculated.
also based on prospectus.
Yes, prospectus, investment prospectus. If it is a closed-end funds, then investment will be closed most of the time, right? So you won't see much of activities and all. So once you calculated total assets, then you can calculate the that management fees and apply it in the books of account and then publish your NAV as you have incurred the management fees for this particular quarter or year, right? In case of let's say mutual fund, so you would say daily that you need to calculate it.
Yes.
So that doesn't make any sense to calculate it in close. Then you will have to calculate it in open. So there are means think about it practically. So depends on the fund structure, depends on the investment type, instruments type. In case of side pocket investment, so that investment would be kind of let's say the distressed assets or bonds which are not traded in the market. Let's say Sri Lankan government bonds. Right? In that case, that doesn't make any sense to calculate the NAV on the basis of open, right? That will be closed. But here, two aspects, see, whether it is closed or open. So your management fees, you would calculate on the basis of total assets. Once you measure the total assets on accounting date, you need to calculate the management fees and provide the accounting treatment. That's it. Whether it is closed, open, that's. Mhm.
While I was working on it was as you said, we have
Mhm.
and it was like a monthly NAV calculations and we calculated gross rate.
Yes.
It was yeah.
But in both the cases, see, ultimately logic would be remain same or way of calculation would be remain same.
Yeah.
Total assets. For us, the matter is total assets. So on the basis of total assets, you can calculate the management fees. Measure the total assets. Apply the accounting treatment.
My last question is about crystallization
Hmm.
of
Hmm.
so my understanding is like so however like let's say that's a monthly basis we calculating this performance fee maybe annually also.
Hmm.
So for 1 year we might be able to pay the performance fee. This year without no performance we might be not that much this performance fee. The third year again we have to. So let's say like the fund is going to wind up after 50 year. So that crystallization, as per my understanding, crystallization is worked for the last year of the performance. So let's say that the fund started with 100K and then 500K and after that preferred investment. So the crystallization will be, I mean, that will be full on to the equity asset in the year. For I
Let's say this is your data, phase data, right? Initial investment start at this. So when you chart out in graphs, so it becomes very easy to explain. So let's say investment start like this, right? So fund decided means already fund announced that the 10%, so that becomes your high watermark. All right, 8% on 100 USD means 100 USD is the initial investment. So that becomes your here. So it means 108 becomes your high watermark, right? High watermark line. So here quarter one ends, and you calculated the management, incentive fees, right? So current market investment is 108, and your fund reached at 120. So now calculate the management fees. Sorry, incentive fees. How will you calculate the incentive fees?
incentive fee is calculated after my
100 into 8.
yeah.
preferred return, or maybe let's say your high watermark limit means every fund that commit, right?
Yes.
So what we'll do is just calculate it. 8. So it becomes around 102 if I'm not wrong, right? Because 108 it's become 8 divided by 4, right? 2 it means 2 rupees for per quarter. So for first quarter your high watermark would be 102, but fund reached at 120. It's kind of same again, reset that you can keep in mind, reset structure that you can keep in mind. So here, so fund will generate the incentive fees on 120 minus 102, so around 18, 18, sorry, 18 rupees only, or $18. So $18 into 20, if the incentive percent is 20 and divided by 100, then pay the incentive fees. But the point here is till 120 investors paid fees, investor paid fees till 120. Let's take the example of quarter 2 and then see means comparison. Again, then fund performs well and reach to the 130. You are doing the accounting here. Then calculate the incentive fees quickly. Again, so 8%, 8%, if the 8% was the 8% was the high water mark for a next, then again you need to calculate the high water mark on 120 for a next quarter. Why? Because we have already paid fees until 120. So you need to calculate 8% high water mark on 120. Just calculate it. Calculate 120 into 8% divided by 100. Quick.
It's 9.6. It's 9.6.
So around 9.6.
139.6.
129.6. So here your high watermark reached at this. But here fund again perform up to 130. So it means you would see incentive fees will be generated on the difference amount, means 120 minus 130, right? Or just calculate your high water mark, not 129. So the reason is, so this is your annual 9.6, your annual high water mark. But what about quarterly? Tell me the quarterly. 9.6 divided by 4. 2.4. So 122.4, that becomes your high water mark. And fund generated return 130 minus around 8. So on 8 you need to pay the incentive fees. Again, investor pay the incentive fees here. Incentive fees here. So think about it. So whenever investor pays incentive fees, that level you can call it as a crystallization. Why crystallization? Because investor cannot pay the fees, means double fees on the same limit. When the crystallization is set, so it means assume it in the third quarter fund performed like this and reached at 120. So if the crystallization is 130 and fund performance reached at 120, so it means until your performance reached to the same level 130 or more than that, fund will not pay any fees to the incentive fees to the investor. Why? The crystallization point is 120. Crystal, it means it's a clear point. Crystal and clear. When we say, when the point is certain, label is certain, it's a crystal clear. So do you get crystal and clear about this, whatever discussion we have done? If you say yes, it means you guys are aware about it. So you are aware about it, whatever points that we have discussed. So the crystallization point is 130. In the first quarter, the crystallization point is 120. So investor and fund manager both are aware about it. So fund, it needs to be performed more than 120, and that's what we have calculated fees here. And but in the third quarter, if you see, crystallization point was 130, but fund reached at 120.
Okay, let's say take an example like we are which for all 2 quarters we are supposed to pay the third quarter we are by no performance. Again, let's say fourth quarter was not reaching the second high water mark. So what about the annual payment of performance fee? Still we are going to pay it like whatever it's right, or we're not?
Can you repeat it?
For the quarterly crystallization is like just before that crystallization is a product
Yeah. It's a payment, so it means still see, you can take it in both the ways. If here, let's say whatever fees, let's say $2 or 2 rupees. If that investor paid it, so that becomes you paid, so you don't need to accrue it. And if not, then you can accrue it. So that depends on their investor that accounting cycle, whether they'll pay annually or quarterly. But most of the time, incentive fees and management fees, they paid it quarterly.
That's why my point is like the accrual is like
Then you can accrue it incentive, and that's what your accrued incentive is come into picture.
yeah, that's what my point is. So let's say first 2 quarters we have accrued the performance fee. Third and fourth quarter, at the end of the fourth quarter, we are at the last, like we are not performing, not even
The same fees it will be carried forward, so you don't need to charge or add any other additional fees. Let's say here 2 and here 2, so 4 rupees would be the fees for third quarter as well, if it is accrual basis accounting, because investors will make the payment annually. That's the difference.
my question is that until end of year is more than a high watermark performance will pay or investment.
Now you tell me why. See, ultimately you invested 100, and if the fund could perform only, let's say, up to 80, so it means you invested 100 and now your investment value is 80. Why will you pay it? Think practically. You invested at 100 and your investment value is 80. Why will you pay the high watermark? It's a marketing commission, dear. Always we pay the commission on the basis of performance, not on the basis of capital. You don't need to confuse anything. Here also, if you see crystallization, it means investor already paid on 120. So he cannot pay again on 120. So can you pay twice? Let's say I have asked you to pay 2,500. Will you pay 5,000 to me? No, you will pay only 2,500. Why? Because you will say like, hey, I have already paid 2,500. So why should I pay again and again same fees on same? That's the difference. It means fees will be paid only once. And that's the why we are saying crystallization, because the label is crystal and clear. That label is crystal. Crystal, it means it's a clear 120. On 120, investor already paid fees 2 rupees or accrued 2 rupees. So investor will not be able to pay then on 120 again. So fund will have to perform more than 120, then fees will be generated. And here, that's what I showed you the graph. So it means fund perform it. See the upward trend. But in the third quarter,